BBVA Colombia's first quarter 2024 earnings call. I am Diana Caterine Ruiz, representing the legal department of BBVA Colombia. Joining us today are Alejandra Rees, Juliana Girón, and Daniel Leonardo Vargas from the Financial Planning and Performance team, along with Nicolas Tripodi from the Risk Department and Mario Sanchez, our leader in ALM and Investor Relations. As a reminder, today's presentation will be accessible for download on our website under the Investor Relations section at the link labeled Agenda. Please be informed that this call is being recorded. To participate in the discussion, you can use the chat feature or simply raise your hand using the button located at the bottom right section of your screen. Our agenda for today includes key highlights from our quarter, a brief overview of the macroeconomic landscape, insights into our financial performance, and a discussion on recent achievements. Without further delay, I'll now hand over the call to Mario Sanchez.
Thank you, Diana. Good morning, everyone. As Diana mentioned it before, my name is Mario Sanchez. I am the head of ALM and Investor Relations in BBVA Colombia. I am delighted to welcome you all to our earnings result call today, where we will reflect on our achievements during this challenging first quarter of 2024. As usual, during the call, I will invite the members of our panel to join us and give focus on relevant topics. We would like to begin on slide 2 with the first quarter 2024 key takeaways. We will deeply cover these points during the session. This quarter net results was a loss of 136 billion, mainly to the deterioration in asset quality and provisions as a result of the still high inflation and interest rate. Despite the hurdles posed by the tough economy, we are increasing our market share in Colombia, and we achieved 5.14% growth loans versus the first quarter 2023. On the other hand, we would like to remark that our operational efficiency increased by 8 basis points year on year, and we achieved an efficiency ratio of 64.1%. BBVA's efficiency combined with the ease we experienced in funding costs during the quarter allow us to obtain operating income 2.7% higher than last year's figure. As mentioned before, our asset quality has suffered during this quarter, but it is still substantially better than the industry average, and we maintain a solid capital position with 81 basis points above the minimum regulatory level. After this brief introduction about the key topics that will be covered during the conference, I would like to hand over the call to Alejandra Rees, our senior economist, who will explain to you our view regarding the economic outlook.
Thanks, Mario. Good day, everyone. Let me start with our economic outlook on slide 3. The global economy continues to show resilience with some mild moderation in activity in the US, but above expectation results in China and Europe. Despite this, we expect a moderation in activity in the remainder of the year. On the inflation front, we have seen relative stability in the latest prints, mainly due to higher persistence and high demand on services, particularly rents. In this context, authorities have continued to deliver their speech of higher rates for longer. We consider the Federal Reserve will start its reduction cycle in September, later than initially discounted, and will do a gradual reduction with 50 basis points in 2024 and 125 basis points in 2025. For Europe, the start of the reduction cycle started in June, but there are some risks driven by a high print in inflation in the latest report. Despite this, we expect them to reduce rates again in September and hold until the start of 2025. On the local front, on slide 4, the economy grew 0.7% year-on-year in the first quarter, close to the print for 2023. Despite this, the quarterly growth showed a second consecutive print in positive territory with a 1.1% growth. In terms of its main drivers, activity continues to be held down by internal demand, with private consumption growing just 0.6% and public consumption contracting 0.7%. On the investment side, we continue to observe poor results with a contraction in the first quarter of 6.5%, which compounds with the weak performance in the latest quarters and holds the investment rate close to 17.7% in 2023. To offset this result, external demand showed a better performance driven by a significant contraction in imports. We expect activity to improve gradually in the second half of the year and reach a year growth of 1.1% for 2024, with an upward bias, a mild improvement relative to the 0.6% of 2023. Inflation has continued its downward path, standing in April at 7.2%, more than 600 basis points below its peak in March 2023. The size of the moderation reduced this month due to encountered trends. On the one hand, core inflation continued to reduce mainly due to base effects and low monthly inflation in the goods side, despite higher than usual monthly rent prints. And on the other side, an upward trend in food inflation for the first time in close to a year. This as a result of low base effects and some impact in climate-related shocks. We expect inflation to have a couple of months stable at current levels and then proceed with its downward trend to close 2024 at 5.4%, still above target but significantly lower relative to the end of 2023. In this context, the central bank has continued its rate reduction cycle, accumulating 150 basic points of reductions. Despite this, real rates remain close to its highest and monetary policy remains severely restrictive. In light of the short-term transitory in light of short-term inflationary risks, higher than expected activity numbers, and a later and milder rate reduction on the Fed side, we expect BANREP to continue in the next couple of meetings with the status quo rate reductions of 50 basic points, but should be able to increase the pace from September, closing the year at 8.5%. Finally, on the structural balances, the economy continues to observe relatively low for Colombian standards current account deficit to GDP at around 2.7% for 2023 and 2% for the first quarter of 2024. But we expect it to start deteriorating along with the expected improvement in activity in the second half of the year, closing near 3% in 2024. This greater deficit will continue to be financed mainly by FDI flows. On the other hand, the fiscal balance has shown some pressure from lower than expected revenue. We expect a deterioration in the fiscal balance in 2024 relative to the one observed in 2023, closing near 5%. All in all, the greater expected imbalances and the important reduction in interest rate differentials with the Fed will pressure the exchange rate and produce a depreciation that should materialize in the second half of the year to close slightly below the 4,200 mark. Thanks, Mario.
Thanks, Alejandro. Now going forward with the slide 5. This quarter, our digital and mobile channels have demonstrated resilience, maintaining a stable performance. With 2.2 million digital customers and 2 million mobile customers, we have established a strong foothold in the digital landscape. We are proud of our high level of engagement from our clients, with 79% actively interacting with our digital platforms. This underscored not only their trust in our technological capabilities, but also the seamless integration of our digital solutions into their daily lives. Moreover, the fact that 81% of our sales originated from our website and app highlight the effectiveness of our digital channels in facilitating transactions and enhancing customer experience. Looking ahead, our focus remains on innovation and improvement in our digital and mobile offerings. By continuing to refine our platforms and introduce new features, we aim to further enhance value for our customers, making their lives easier and their interactions with us more meaningful. Now, as we transition to the discussion of key financial indicators on slide 6 and 7, we are poised to gain deeper insights in our performance and strategic directions. Daniel, could you please provide us with your analysis on these critical aspects?
Thank you, Mario, and good day to everyone.
Starting with our activity, the scenario of declining interest rates has allowed us to begin the year with strong growth in the retail portfolio, particularly in the mortgage sector, which grew by 4% year over year. Additionally, the consumer portfolio, mainly driven by payroll loans, grew by 11% year over year. On the other hand, the commercial portfolio is experiencing modest growth at 2% year over year. However, we have observed that this is a widespread situation in the market that is growing slowly in the first part of the year. This had led to an overall growth of almost 5% in the total gross portfolio. Moving to the profits, we observe firstly a recovered net interest income growing by 8%. This is the result of a very prudent liability management strategy that has allowed us to take full advantage of the improved liquidity conditions in the market. Provisions continue to be a challenging area during the first quarter as we experienced significant deterioration in the personal loans portfolio, resulting in a cost of risk of 3.6% higher to the previous one. Expenses are naturally increasing as a result of the salary rises at the beginning of the year, in addition to the substantial investments we are making in CapEx and costs associated with technology renewal. This demonstrates our continued commitment to growth and to providing digital solutions for our clients. All of the above has led to a negative result during the first quarter, mainly due to the poor performance of provisions. However, with a very good trend in the net interest margin, we project that this will allow us to secure profits in the upcoming months.
Thank you, Daniel. Moving to slide 8, we would like to highlight some key points regarding our funding strategy. Year on year, our market share has increased and we have been able to fund this growth in assets mainly with term deposits and saving accounts. Our funding mix ensures a solid financial position, following us to comply with internal and regulatory requirements. Quarter over quarter, our funding mix has experienced minor changes, a slight decrease of 3% in savings accounts and has been replaced by time deposits. If we compare this quarter funding composition with the figures 1 year ago, we can note that we have increased our liabilities while maintaining almost the same structure and mix of resources. Checking accounts has decreased its share by 1%. Meanwhile, time deposits have increased by 2.4%. Savings accounts maintain its proportion in the funding mix. In order to remark Daniel's words regarding net income interest, as shown in the graph of slide 9, credit spreads have been decreasing since September 2023 and especially throughout 2024. BBVA funding strategy based on our view of the shape and trend of the interest rate curve combined with narrower credit spreads have allowed us to sustainably decrease the funding costs, thus increase the net interest income. Now let's continue with slide 10. Please, Nicolas, can you please explain us the asset quality?
Yes, good morning, everyone, and thank you for allowing me to participate again in this forum. My name is Nicolas, and I am the Director of Retail Credit Risk. The year-to-date cost of risk stands at 3.61%, characterized by a January impacted by double maturities that were transferred from December 2023. The cost of risk calculated based on the last 12 months is below 3% and also below the ratio observed in the sector. The credit products with the highest weight in our provisions are personal loans and credit cards. For those two products, which account for 15% of the total portfolio, we have been evolving our credit policies over the last 6 months. The new production shows clear signs of improvement, and this better origination mix would contribute positively to improving the risk indicators. As you can see in this slide, NPL and NPL plus write-off ratios continue to be below those of the sector, with absolute and relative growth better than observed in the competition. with the commercial portfolio standing out. However, related to the commercial portfolio, we maintain continuous monitoring and policy adjustments in sectors with deterioration, such as health, government contractors, housing builders, energy dealers, and telcos. In consumer, although the NPL ratio is slightly higher than that of the sector, when including write-off, we are well below it, 10% against 16%. The implemented credit policy measures, along with the recovery strategy, will help us change the trend observed in this graph. We maintain our projection for improvements in the risk indicators towards the second half of the year. Finally, we continue to improve our management tools. In the admission side, we recently implemented a new model with alternative data in our digital flows that we hope will help us in dealing with new-to-bank clients. And finally, in the recovery side, we have included do-it-yourself solution in the app for clients with delinquencies. Thanks, Mario.
Thank you, Nicolas, for your take and explanation on asset quality. Now we can move on to slide 11, where Juliana Giron will explain our capital position.
Thank you, Mario. Good morning, everyone. My name is Juliana Giron. I'm the manager.
Sorry, Juliana, we are losing you. Can you please
Can you hear me?
repeat?
Yeah.
Yes, now
Okay.
we can hear you.
Thank you.
Can you repeat from the beginning, please?
Thank you. Good morning, everyone. We end the first quarter of 2024 with a total capital ratio is of 12.07%. This is 57 basis points above the regulatory limit. Additionally, in our CET1 ratio, we have a difference. We have a difference of plus 81 basis points above the regulatory minimum. During the quarter, we had a decrease by minus 33 basis points in the total ratio and minus 23 basis points in CET1 compared to the previous quarter. This decrease is mainly due to a negative results during the first quarter. In terms of quarterly evolution, risk-weighted assets have decreases due to a reduction in market risk and a credit risk. The market risk, which had a reduction of minus 2%, and credit risk had a reduction of minus 1%. The effective management and a continual monitoring undertaken at the bank enabled us to conduct our operations while maintaining favorable indicators of equity quality and solvency, always making sure that we stay above the minimum requirements. Thank you.
Thanks, Juliana. Moving on with slide 12, it is an honor to be here today to share with you the impactful work that BBVA has accomplished in Colombia during the first quarter of this year in the realm of social investment. In such a short span, we have managed to make a difference in the life of thousands of Colombians through various initiatives focusing on education, humanitarian support, and sustainability. Let's start by talking about education, a fundamental pillar in our social investment initiatives. During this period, we have reached over 11,500 Colombians, bringing education and opportunities to vulnerable communities across the country. From senior management, we have support and accompanied various activities, such as the delivery of computers, physical and digital libraries, and school kits in places like Leticia, Armenia, San Andres, and in Irida. We have made a significant impact improving tools and resources for the learning and development of children and young people. Additionally, we are committed to reducing the digital divide is reflected in the donation of laptops and tablets in the Colombian Pacific, benefiting over 6,000 students in the region. Corporate volunteering has also been an integral part of our focus on education with the participation of committed employees. We have delivered and organized resources for educational institutions such as the Renacer Association, which serves children, youth, and adults with disabilities or cognitive limitations. But our work goes beyond education. We also care about supporting communities in emergency situations. In Chocó, we have provided 500 humanitarian aids to communities affected by various social crises and environmental disasters, those reaching 2,000 people in critical moments. And we cannot overlook our commitment to sustainability. At BBVA Colombia, we have determined to support our clients in their quest for a more sustainable future, from financing projects with a positive impact on society and the environment to promoting sustainable business. We are committed to inclusive growth and climate action. In the first quarter of 2024, we disbursed a total of COPI 2.2 trillion in sustainable operations and projects, those marking our commitment to a greener and more equitable future. Our strong performance in these areas reflect our credit strategy, which seeks to generate not only financial returns, but also to promote sustainable development and social equity in our communities, from operations focused on sustainable mobility to financing initiatives with a strong environment impact. We are demonstrating that it is possible to unite financial success with social and environmental commitment. In summary, the first quarter of 2024, has been a period of significant achievements for BBVA Colombia in the field of social investment. We will continue to work tirelessly to make a positive difference in the lives of Colombia and build together a brighter and more sustainable future for all. Finally, I would like to thank you all for being present today. Despite the challenges of this first quarter of 2024, BBVA Group is deeply committed to invest and transform its business in Colombia. We have confidence that the measures we are taking to improve our consumer loans portfolio asset quality and the fast reprice of our funding will pay off. With further ado, we will open to questions. Thank you all.
We have a question on the chat. It says, could you comment on the ongoing capital increase announced in April 2024, size, timing, and expected impact on capital ratios?
Okay, so I will comment on the subject, and I don't know if Juliana or Pablo want to address something additional, please be welcome. The operation already happened as we publish as a relevant fact for the market. We receive around 200 million euros from our principal shareholder, that is BBVA Group. We receive her on April at the end of the month as a capital anticipation. This operation will be seen in the equity probably at the end of July when we finish our issue of equity to the market. The estimated impact in our solvency ratio is 140 basis points over the actual solvency ratio that you can be or that you can see in this presentation.
There is another question. Expected ROE for 2024.
We have no data metric at the hand, so we can calculate and send it to you maybe after the meeting.
Okay, I see there is no more questions, so we conclude our event. We appreciate your participation and we hope you have an excellent day.
Thank you so much. Have a good evening.
Bye bye.